Tapestry, the owner of Coach, Kate Spade, and Stuart Weitzman, announced it would be acquiring Capri Holdings. That's another global luxury fashion company that owns Versace, Jimmy Choo, and Michael Kors, bringing 6 brands together. The two companies, when combined, see sales of over $12 billion and locations in over 75 countries. This news is riding the tailwinds of CPI data released this morning as well. Apparel saw no change from the prior month in price, but it has risen 3.2% year over year. So let's talk about the state of retail and this deal specifically with BMO Capital Markets retail and services analyst Simeon Siegel. Simeon, it's great to see you. I was texting you this morning and I called it sort of like baby LVMH that they're trying to put together here. What does bringing these brands under one umbrella do for Tapestry?
I'm sure they love that phrase, by the way, Julie. That's probably the cherry on the top. Good to see you. So I think that, I think there's no question. I think we're watching certain pieces of luxury businesses being grown. We keep hearing about the European conglomerates left and right. And I think maybe with the U.S. side doesn't get as much credit. And so this does, on the one hand, feel like both Tapestry's way of taking advantage of depressed multiples in general across the space, and then also buying their way into cash-generating Michael Kors, and then luxury businesses, Jimmy Choo and Versace. So it's an interesting diversification, and I think it is an attempt now at expanding the scale and creating a version of the U.S., the same European powerhouses.
Simeon, I continue to read about this new age of quiet luxury, if you will, and I can't help but wonder, for those who find themselves as power purchasers within the luxury market, what this does, what this combination looks like for these two companies, how they benefit even in that age of quiet luxury that we've continued to hear about from analysts and some investors out there.
Yeah, it's an excellent question. I was waiting to see your logoless cashmere hat. But I think at the end of the day, not every part of luxury is quiet. And we know that. I mean, logos will always have a place. And generally speaking, when you're referring to quiet luxury, it's also a different scale. So I think right now, the sheer revenue size, that beautiful PDF that we had over there showing the 12 billion revenues, argues that these are very real businesses with very real customer resonance. I think you're absolutely right. This quiet luxury has become a nice buzzword, and it has implications for how far to take logo and for how much you can raise your price with flashy logo. But I think that when you look at that revenue base of Michael Kors and Coach, and you see who they are selling to, there is still a strong desire for that product.
I'm curious about the price that they're paying here. Now, by my math, it was about a 65% premium to yesterday's close. But to your point here, the valuations have been depressed. So how should we think about how much Tapestry is paying up for Capri?
Yeah, it's funny. It's actually below. I mean, you and I have talked about Capri for a while. It's actually below my price target. Not that my price target should mean a lot, but I think exactly your point. When you think about what's happened across retail, we went from 2008 to 2020. Retail is supposedly dead. In 3 months at the end of 2020, because of inventory scarcity, retail was absolutely back and party like it's '06. And then the last year, we've gone back to retail's dead. None of those extremes were actually true. But I think what it created was this opportunity for Tapestry to look at one of their primary competitors and adjacent companies and take advantage with a premium that was really nice relative to the close yesterday, but all things considered, still not at peak. And so I think that's a very important point, and it's probably an important point for the rest of the sector.
Do you think there's going to be any massive restructuring to how the storefronts are laid out? Because, I mean, these are brands that everybody knows, but as standalones, they've always been accustomed to having their own storefronts. And so now that they all roll up into one, and it's not necessarily that Tapestry has combined even the brands that they did acquire and create under one umbrella company. So is there any change in strategy that you expect?
I think it's interesting. When you look at the Gap portfolio of brands, you see a website that shows you all three. The consumer generally knows they're owned by the same. When you take Julie's adult version of Tapestry, the European luxury houses, most people don't necessarily. The consumer doesn't associate them as being one parent. I think it's probably going to be more of the latter. I think the synergies are back office. I think the synergies are recognizing there's two corporate offices, more so than, and again, I don't know, but more so than what I would assume will all of a sudden become side-by-side locations saying walk into either Coach or Michael Kors. So I think that keeping the brands, letting them have their own distinct identities is probably critical. I think it's a really good question, but I would, at least from my seat, I would assume the synergies are more going to be back office. I think if they blend the brands, they end up diluting the brands.
Samin, let's take a step back and talk about the state of luxury here, or at least high end, right? Ralph Lauren also reported today, by the way, came out with some muted guidance. Capri, which was supposed to report, now is apparently releasing its earnings after the close today. Tapestry reports next week. What does that picture look like?
So it's interesting. I was looking at this right before I joined. The majority of the consumer discretionary companies that have reported so far have seen gross margin go up, have seen revenues grow by low single digits. All things considered, that's a really good report, right? We haven't been able to say that in a long time. Part of that is because we're lapping supply chain issues. So part of that is the benefits to gross margin that you're seeing from commodity and logistics. But all things considered, consistency, nice, small growth is a lot better than huge ups and downs. On the other hand, the stocks are actually, generally speaking, underperforming the S&P when they report, and that goes back to the sentiment side. So I think the way that I'm thinking about the world right now from a fundamental perspective rather than from a Wall Street perspective is we're actually back to an environment where retailers can run their businesses. Beginning of COVID, there was no supply chain, therefore there was no availability, so it didn't matter how good you were at predicting demand. You were at the whim of whatever product made it through the containers. That's no way to run a business. There's no winners and losers there. And then in the last year, it was the opposite, where everyone had so much excess inventory that it also didn't matter how good you were at predicting demand. You were just overflowed with this product that you had to move. We're back to normal. And again, that's a hard thing to say because what is normal? But we're back to an environment where I think the companies that are really good at understanding their consumer and predicting inventory accordingly will win. Whereas the others will find themselves overflowing with promotions, not because they have excess inventory, not because they have a lot of inventory, but because they have more inventory than their demand. And that was a predictability function. That's comforting, right? That means that the ability to execute, the ability to triumph as a retailer is back in the pocket of management. And we haven't been able to say that for a while.
What would you say is your top pick as we go into the thick of earnings season?
So Capri was one of them. It's probably not a fair thing
That
for me to
worked
say
out
right
okay.
now. But I think if we think about Capri, I think the reality is it was incredibly cheap. And did I have any idea there was going to be an acquisition? Certainly not. What I looked at was a risk reward framework. I think if you think, you and I've talked about companies like Bath and Body Works, which are replenishment driven businesses that are trading very cheap. I think it's too easy just to look at PE normally and say if something is below 10 times in my space and there's some semblance of predictability. But right now that it's probably a worthwhile endeavor. And it doesn't mean you're going to get these catalysts right away. But I think there's an element of looking at risk reward. I think certain times you want to make sure you have the catalyst coming up and you want to have a general view of what earnings are going to be to the extent you can. Other times you want to say, if my downside's protected, if the company is intrinsically worth more than the market is paying for it now, at some point it will go higher, whether because a public investor comes along and decides it's worth more, or whether a Tapestry comes along. And so I think that's the interesting dynamic here, where we still have Capri, I think, will wake a lot of people up to the fact that perhaps the floor, the valuation floor for a lot of these companies should be higher. They still need to perform. They still need to earn it. But there's a lot of companies where valuation simply hasn't mattered and you could just keep going lower. And I think that might at least take a little bit of a reprieve right now.
All right. Going to keep my Versace flip-flops in the cart for right now. Thanks for breaking this down for us. BMO Capital Markets Retail and Services Analyst Simeon Siegel. Great to speak with you this morning.
Good to see you guys.